Rachel, and the iPads have become a bit of a feature of our event, so hopefully you'll enjoy them as much as you did last year. So let's look about what we're going to do today. Well, essentially, we've named this event Live, Thrive, Survive, and we're focusing on the challenges that you all face in the auditorium around running your business effectively. So Live is really just sort of getting things going from inception for the first period of your growth. No particular time frame, but businesses, as they develop in their early years, face many challenges. And we'll be talking with the panel I have here about some of those challenges very shortly. Thrive, or the getaway, this is really about managing the bumps in the road, the things that the regulator throws out in front of you, the things that you need to deal with. So we'll be looking at things like the AFMD. We'll be looking at some of the challenges around marketing your fund, both here and in the US, or establishing businesses in other places. So a lot to be in that session, building on what we have covered in Live. And Survive is, well, what happens tomorrow? And Survive is about the latest regulatory developments, the things that are going to be testing you in a year or two's time, as well as the FCA's regulatory agenda and that of the SEC. And we'll be looking at supervision and enforcement. We used to say here that the FCA was not an enforcement-led regulator. Well, actually, today it is, because the head of enforcement is running supervision and authorization. So how that will play out and how things will change with a change of leadership at the FCA will be one of the things worth debating towards the end of the day. No doubt some of you will have experienced FCA visits or calls to Canary Wharf for the first time this year. That's a feature, a change. So things are changing as to how our firms are being regulated by the FCA, and we expect that to continue. Anyway, more of that in the Survive session, and if you survive, we'd be very pleased to give you a drink and canapes at the end of the evening, at the end of the day, and to hear a little bit more about your war stories. So that's for kickoff. Our first event on the Live side is set up here. So these are the areas we're going to cover. As you'll see, it's quite wide-ranging. So we're talking about tax, we're talking about risk management, governance, and what directors need to worry about. We're talking about whether you want to use a hosting provider. It's a new way of being regulated, or at least relatively new, and how you might manage your accounting arrangements. So a good deal to cover there, combined with a discussion of what compliance infrastructure you might need to keep on the side of the good. When you are setting up and running a business, there's a huge amount of things that you need to concern yourself with. This slide is a representation of how we at Cordium add value to that journey that starts with the entrepreneurial idea and the business inception, and hopefully at the end of that journey allows you to extract value, whether that be on a year-by-year basis or in a business transaction. But Cordium is there to help on the tax, the accounting, the risk management, the compliance, and a whole range of other things as well. So we are really in place to support your management company as it grows and succeeds. So as Rachel said a little bit earlier, we're going to start with a word cloud. I think this may need a parental advisory sticker on it, but that's for you to determine. So I'm going to ask you one question. If you can get to your iPads, you'll have about 30 seconds to key in your particular word. But what word would you use to describe the first 18 months of running your firm? And that might be when you took over running an existing firm or when you started a firm at the first time. But what word would you use to describe your experience? Because we'd like to know, and I'm sure we'll get some interesting answers. So without further ado, I will now hand over to Lawrence Parry. Lawrence is one of our private client tax partners, and Lawrence is going to compare the first panel. So over to you, Lawrence, and thank you very much.
Thank you. really, really interesting words coming up here. Challenging, frustrating, busy, exciting. For those of you who are either new parents or remember the time when you were new parents, or even when you were the children of new parents, that sounds exactly like how I remember it was when my kids were young. Time, busy, exciting, roller coaster, definitely unpredictable. And so starting off in business is exactly the same. It's your baby. It's there, it's beautiful, it's lovely, but now what are you going to do with it? With the panel here, we're going to set out and explore some of the issues that you will have in that first period of running your business. We've got some experts in the field, and if I introduce them and if they wave, then you'll see who they are. Starting off with Ellis, who's a partner in funds and financial services at Mishcon and Reya Solicitors. Eve, could you wave so people, yeah, that's fine, yeah, right, yeah. We've got Jonathan Mott, who's compliance officer, Mirabella Financial Services, formerly at the FCA. Elisa Perna, chief risk officer for Mirabella. Can you wave, Mirabella? Process of elimination, yes. John Davison, who's one of our 4 tax partners now at Cordium. Yeah, okay, very well, yeah. A bit more engine. Yeah. Used to be head of tax at the IMA some years ago, and Matthew Crisp, who's our partner in financial and regulatory reporting at Cordium. So, if you're really moving on, sort of taking that word cloud a bit further forward and maintaining the interaction, because we've got to keep you sort of going throughout the day, so interaction is a key focus in what we're doing today, is we have our first survey question. And I'd like you to take sort of some thoughts about remembering back to when you were setting up, sort of what were the biggest challenges that you faced? Those words were coming up: exhilarating, roller coaster, challenging. So what were they, if you can narrow them down? Was it really? Should be appearing hopefully on your screens now. Nod to let me know that you've got them. Yes, I'm getting nods from the back. That's excellent. So if you could select one of those, just so we can influence sort of what we're talking about. So with the getting authorised, 14%, fund structure, 14%, tax structure, hopefully you were getting good tax advice because that's relatively low down. Attracting investors, by far and away the biggest issue for new businesses. And that's something we've seen at Cordium over the last, certainly 3 years plus. So, and then within that, getting the firm's compliance infrastructure right at 27%. So, attracting investors, 42%, compliance infrastructure, 26%, and then authorization, fund, and tax structure thereafter. So taking that on board, what do the panel think as being all the things that businesses have to deal with? What should their priorities be? Would it be legal? Would it be tax? Would it be compliance? If we start off with Eve, what are your thoughts as to what people need to consider?
I think, not wanting to put legal first, being the lawyer on the panel, but I think one of the most important things that people need to think about when they're starting up is actually what they're doing, and actually right at the starting point, do they need to be regulated to do what they're doing? Because sometimes there are exemptions. So I think one of the most important things is to say, what am I doing? Who am I providing services to? Where am I based? Where am I doing what I'm doing? Where are my clients or my investors based? Am I managing a fund, or am I just managing a managed account basis? And so from that, you can then work out, do you need to be regulated or not? Are there any exemptions? And if you do need to be regulated, actually what sort of permission scope do you need? Because a lot of that then will turn on some of the regulatory and the tax issues, and the legal documentation. So for example, if you need to, if you're an advisor rather than a manager, that will impact on the level of capital that you need to have. It'll also impact on the legal documentation that you need to put in place. So I think the first step definitely is sort of, what are you actually doing? What's your roadmap on the permission scope side? And also, Stephen mentioned it earlier, but it's important that you don't start doing something until you have had that advice, because what you don't want to do is start off on the back foot and be doing something that should have required regulation or required a different type of permission scope. So then when you go to the FCA to get authorised, you're already sort of having to explain why you've been doing something. And because the FCA now is taking more of an enforcement sort of role, that has become even more relevant, I think, now than it probably used to be.
In terms of, so legal and getting that structure, what about tax thoughts?
Well, I guess the first thing with the fund, you think, what's the fund supposed to do? You want to be able to invest as you commercially want to invest, and essentially no tax sticks at the fund. I mean, if you look at the sort of domiciles, I think where you have the fund that's not really driven by tax, it's more regulatory, and that's the UK, I think, in the last few years has become more friendly if you want to sort of have your fund here, but people still aren't parking their fund here. So I think that the sort of regulatory environment is perhaps seen as more restrictive. In terms of the rest of the structure, well, I mean, the investors generally should be paying tax where they live, and then it's a matter of who's adding value and where. So I guess it's a case of looking at your value chain and thinking about where where can you get the investment management stroke advisor? Where's that need to be located? Generally, the kind of economic value add there is quite high value. So if you've got it here in the UK, you'll pay a decent amount of tax on it. The other bits and pieces, the sort of depository stroke fund administration, could be done locally. So not such high value add, but low rate of tax. So yeah, I mean that's.
So in terms of priorities, what about the regulatory process and the like?
Yeah, so I suppose if you've been to work out where the best, most efficient way of structuring for tax purposes, you've been to see Eve, who's told you kind of what permissions you need with the FCA, and then it's trying to work out how you then get past the FCA process. I think first you've got to work out what type of firm you are, and Eve touched on this. Are you we've talked a lot in these last few years about the Alternative Investment Fund Managers Directive, the AIFMD. Now, are you managing are you the substantial manager for an AIFA, a fund that's not a UCITS? Are you a MiFID firm? Are you providing services to an AIFA? Are you providing services to a managed account? Are you for a fund of funds or real estate or private equity? Are you providing just advisory services to an offshore manager who's making the decision? And this will then form the basis of your authorisation. So the next hurdle is this authorisation. It's the FCA's due diligence process on yourselves, and it's quite a tough job. I was surprised to see that relatively low down. Hopefully that you all are using us and we made it helpful for you. But what the FCA are looking for is to understand your business model. They want to make sure that they understand, or make sure that you understand what the sensitivities and threats are to your business model, to ensure that you've got the right governance around that you've got the right committee structures. And for smaller firms that we see, it's more about kind of dealing with that, I suppose, Bernie Madoff risk. Is there appropriate change within the business? Then they'll look to see that there's the right amount of individuals. I think we'll talk a bit more about individuals and how other people can play a part in that. But are they the right people with the right experience? And then it's the infrastructure. There is a lot of worry about compliance now. As Stephen said up front, there are more formal enforcement officers in the supervisory functions now at the FCA, and I think people are worried about getting their compliance infrastructure right. Something that does meet the style, scale and nature of a business. And then it's about capital, and I know Matthew will talk more about capital, but it's there. The FCA will look at firms like this as a gone concern. They will look to see projections, but they want to know that you've got enough capital to wind down the business.
Can I stop you there? Because actually, we have just got our first question. And our first question is it sufficient to meet the regulatory capital requirements, or is the regulator likely to press for more than the regulatory requirements? And how good was that? I mean, if anybody wants to ask other questions just before we get to that subject, that would be really good. Please send questions in. If we don't get to them, if we come to them later, they're all being recorded, and we'll try and answer as many as we can, if not here, by email later on.
Do you want to start?
Well, that falls quite squarely to me, I think, to respond on that point. as we already said, once you've outlined what your permissions need to be, that does drive your regulatory capital classification, which drives the minimum amount. You are, of course, submitting projections at this stage, often for a business which either doesn't exist or exists in a very different shape and form, not requiring regulation. So they are projections. The FCA appreciates they are projections, and they need to be prepared on a best endeavours basis. So the FCA will also, as part of understanding how risk is managed within the firm, look to see a sizable buffer over the minimum regulatory capital requirement. Typically, we see very few questions being asked around projections which demonstrate at all times during the forecast period of at least 12 months a surplus of approximately 20%. So that's a fairly good benchmark, tried and trusted. But really that benchmark margin is there just to allow for variations from the projections to the actuals. For example, your expense run rate may be higher than expected. You may need more people than you originally anticipated. You may decide at some stage that capital raising isn't going quite as well as you'd like it to, and actually you need a presence in Mayfair rather than somewhere else in London, perhaps in a cheaper area. And really, the ability to gather assets is driving your top line, driving revenue. So that's really the figure which is probably most subject to variation in reality as you progress. So it's a buffer to compensate for that variation, which is bound to occur to some degree over the future.
Yeah, and I think there is a certain amount of how you demonstrate that you've got the appropriate risk management function and you are managing the risk to the business. I mean, the FCA, through their ICAP process, I don't know how many, the individual capital assessment process, do look at how you manage risks, and certainly if you're managed by a supervisory team at the FCA, they will seek to understand how much capital you need to add on to that. So yeah, I think it's important that you write through your application how you seek to manage those operational risks that otherwise would be have to have some capital impact against them.
Thank you. So, in terms of those are priorities for setting up in business, and John touched upon sort of where you're actually based, whether you're the fund or whether you're and the management or advising entity. It would be really interesting for us to know, and so we're moving on to the second survey poll question. And this one's split into 3 parts. So, do you really have, is your fund, if you're managing a fund, is it offshore or onshore? And if it's offshore, is it EU or non-EU? Was your choice of fund domicile driven by regulatory or tax? And the third part is, or indeed other reasons. And the third part really is, what is your business? Are you a UK manager? Do you an offshore manager with a UK advisor or sub-manager, whether that's EU or non-EU, or perhaps you're not a manager at all? So if you could turn to your iPads and sort of answer those questions, that would be really interesting. So, answers coming through, slightly over half non-EU, but the rest is split broadly 50-50 EU-UK. It is never let an accountant loose without a calculator, so I'm making estimates here. Tax and regulation, broadly neck and neck. All taxes going forward now. Leaping forward. And again, the majority UK managers. So, interesting answers there, particularly in terms of fund domicile and where your management entity is based. So, taking on board that, and given the fact that you have the answers already, why would you like to consider sort of the issues in terms of where either your fund or both your fund and your management entity should be based? Tax was the first headline up there, so let's start with tax.
Can we see the numbers again?
Can we repeat the numbers? Can we be interactive as well?
throwing a challenge back to the back of the
Yes.
room. So I'm sort of, I shouldn't be surprised at that, but, well, actually, I think tax is a perception. If you look at a fund and it's paying any tax other than withholding tax coming into the fund, then it's not working, because basically the whole idea of a fund is that the investors get taxed as if they were going directly into the investments. So fear of tax is a kind of serious debilitator for fund domicile. And the UK was always perceived as not a great place to locate a fund, because UK funds were taxable, whereas Lux Irish funds were not. And then for the sort of alternative funds industry, then it was places like Cayman and Bermuda. Now, I was actually, can we go back again to the location of the funds? Yeah. So that sort of implies that, I'm not sure if those answers have been the same 10 years ago, because I think the UK has made some changes, and it's sort of improved itself as a tax environment for funds, because you can have exempt funds, you can have transparent funds. And the government has worked quite hard to try and make the place a better place to locate your funds. I'm quite surprised the EU is tailing behind UK, actually, because I would have thought that Ireland plus Luxembourg would kind of completely cane the UK. But again, non-EU is probably, that hasn't changed. And although tax came up ahead of regulatory on the answers, I still think, I think that's probably driven by regulatory rather than tax, because you can put a fund in the UK, but can you do, are you free to do what you want to do with the fund? I don't know. I think there's probably still a perception that the UK regulatory regime is perhaps more restrictive than some of these non-EU locations. But it's pleasing to see the UK has recovered versus the other locations in the EU.
As a lawyer in the financial services sector, what are the issues that you see for fund and manager locations?
I know there's always been sort of a balance between sort of tax, regulatory, and also investor preference. And I think what AIFMD has probably done is make the role of or where the investor is based probably more important than perhaps it used to be, in terms of are you targeting EU investors, and what is the scale of your EU investors, and where within the EU are you looking to go? Because actually, if you're looking to go into the UK, having a non-EU fund is probably all right, because the private placement regime is working well here, and there are other EU countries where it's also working well. So I think the other factor to consider, which has probably become more important, is who are your target investors. If you're going into the EU, do you want to rely on private placement, or do you think actually having the passport under AIFMD is going to be beneficial? And I think as time goes on, we're going to know the answer to that better. I mean, I hear sort of from others that are going through the private placement regime at the moment that actually in practice it's not as hard as I think people thought it was going to be, and perhaps the passport is proving a little bit more complicated and quite expensive. That said, that may sort of iron out over time. The other thing I think that's worth bearing in mind is the asset class, and looking at what type of fund you are, because historically, a lot of private equity real estate funds have had sort of a onshore advisor, offshore fund, and I don't think that that's necessarily going to change a huge amount depending on where the investors are. But the one thing that I think is worth just pausing on is when AIFMD came in, there was another regime that came in at the same time, the EU VECA regime, which is sort of the EU venture capital regime, and that actually allows a nice passport, but only to the extent that you are an onshore manager with an onshore fund, so an English limited partnership with an English manager, and you're small AIFM, and you're investing in venture capital investments. There's a specific category for those sorts of investments. But if you can fall within that, that's a reason from a regulatory perspective actually to keep your fund onshore Europe, because the passport under that regime is significantly easier. There's less hurdles to sort of jump through compared to the AIFMD passport. And it also opens up a broader category of investors that you can target, because there's a category of high net worth individuals as well within that, as well as professional. So there are a number of things to think about, but sort of asset class and investor base are sort of in addition, I think, probably to the tax and the regulatory issues that we're seeing.
We've got a question in from the audience, is that the US has introduced FATCA. We're having, in tax terms, the Common Reporting Standards, and UK FATCA as it's called, although it's not UK FATCA. Do we see that having any issues in terms of fund domicile or in terms of where the funds are going to be located? Or is it just, this is going to happen worldwide?
I think it's quite a long reach factor, and there's not many places that are not frightened of the US in an economic soft power sort of sense. So I don't know. I mean, I think my perception of FAQs is that all the other authorities in the rest of the planet think it's a great idea and would quite like to do the same thing. I mean, it's just all information to be exchanged.
Yes, but that's probably where we're going to end up. In terms of sort of risk and compliance infrastructure, are we seeing differences, EU, non-EU, Cayman, Malta, Luxembourg, Ireland?
I would say that from a pure risk management perspective and portfolio risk management techniques, this is quite irrelevant. But I would say that what really matters for, internally for the risk management function to understand under which jurisdiction and under which regulatory regime we are operating. So of course we are going to distinguish UCITS against, AIFs, just because the regulatory risk management framework is different. And so, for example, for UCITS, it's much more tighter in terms of risk limits and restrictions, while for the AFMs and AIFs, there is lots of focus on the independence of risk management functions. So let's say, we just fine-tune, the risk management policies and procedures according to where the fund is based, but according to what regulatory regime prevails in terms of, the funds we are looking after. And I would also add that, especially with the FMD, we are having some challenges in terms of valuation risk governance, because now the risk management function is much more involved in valuation, because the valuation responsibility is being given to the FM. But when the fund is based offshore, we have lots of offshore jurisdictions, and in general, because the PPM and the offering documents are being drafted, locally, valuation responsibility is still given to the fund's directors, and this is a conflict that needs to be mitigated when you write, the valuation risk policy, which is generally drafted by the investment manager, and given our expertise in pricing models, in general, this task is assigned to the risk management function. So I think this is still a challenge that needs to be discussed, and I think also the FCA didn't give right direction how to resolve this. But I think it's very important to achieve consistency across the internal policies, the offering documents for the fund, and also the administration agreement, because in many cases, valuation is a common topic across all these documents, and we might end up having conflicting messages coming from these different documents. So that's my view, basically.
Thank you. We've got a couple of questions in on sort of practicalities of running the business, and I'll take those at the end when we actually come to talk about sort of running the business on a day-to-day basis. So I haven't ignored them. We will deal with them at the end. So we know the big issues in setting up. We know talked about exactly where we're going to be located, where the money's going to be, where we're going to manage it from, how that's going to be set up. But what are the other sort of commercial issues that people need to consider, sort of out with the actual managing the money process? Eve, do you want to start with that one?
I mean, actually, this goes back to the first polling question that we had, where I think one of the biggest challenges was attracting investors. And I think as much as we sort of on the panel, on the regulatory, the legal, the tax side, obviously that's important, and that's the sort of the bit that we love doing and we help you do. But that's only part of the story. The main part is the commercial story in terms of actually how you attract investors. And so one of the things I find a lot of when I sort of sit down with startup or spin-out managers is very much making sure that, that story is sort of investor ready, and sort of making sure that they've got their track record, that their team is a stable team, that the investment strategy is clear, and also making sure to sort of not waste your time, but you're also targeting investors that are interested in the strategy that you have. And a number of investors that I've acted for, they sort of say the number of PPMs and offering memorandums that they get that don't even fit within their sort of investment guidelines, and they don't sort of get past go, is quite significant. So again, it's sort of making sure that that you are targeting the right people to make your lives easier, so that actually attracting investors, because it's still a hugely challenging market to try and get investors to part with their cash, and also making sure that that the strategy meets the type of investor in terms of high net worth individuals. Family offices may well look for something very different from an institutional investor, for example. And practical things like if you are spinning out of an organisation, making sure you agree with them that you can take some of the track record with you and you can use that when you're going forward, so that you don't end up not actually being able to demonstrate that track record, because obviously if you're starting up sort of a new fund for the first time, you won't have the fund experience within your own fund, but you can take that from previous organisations. So it's making sure that things like that, other things I suppose to think of on a commercial side are also just if you need funding for the management entity or the advisor entity, and how you go about obtaining that as well, which might be slightly different from actually seeking investors into your fund. But that is, I think, that commercial element of things is very key to sort of getting the ball rolling in the right direction.
Taking on board that investor-ready blueprint and looking across your expertise in terms of compliance infrastructure or risk management or the nuts and bolts of accounting, can you talk us through sort of a couple of the key issues that people will have to focus on to get to present ready for their investors?
Shall I pick that one
You
up?
start one up.
I think actually how you present things to investors is very, very important. And documentation and communication are key. So we've talked about risk policies, governance policies. The word ICAP has been mentioned, and we've talked a bit about projections. And I was asked by a startup manager just yesterday, actually, for two characteristics that I commonly see in firms that have been successful as startups. And the two characteristics I honed in on were about documentation and communication. You've got all these wonderful risk policies, governance policies. You've got an ICAP which considers where risk emanates from in your business and where risk could emanate from in your business and how you plan against that. And I think it's quite important to leverage those materials, present them and share them with investors, perhaps in a slightly modified form to make them a little bit more investor-friendly, but to actually show that you've thought through the wider aspects of managing and running this business as a going concern and successful business as it goes forward. What I've also seen in tandem with that upfront piece, linking into due diligence questionnaires or the other documents I just spoke about, is some tactics around your ongoing communication with investors and potential investors. So newsletters, for example, not only including comments on investment strategy and opportunities and where the markets might go in your particular space, but also talking about how you are playing some of the profit back into the business and how you're building out your infrastructure over time. I think people do expect that startup managers will tend to start off with very few people and perhaps not that much formality, as much as is required to comply with the rules, but a proportionate response. But as people grow, I think investors are expecting the managers they invest with to actually plow some money back into the business, become more institutionalized, take on perhaps an independent in-house risk function at some stage. So I think that communication process is quite an important one to the overall aim of attracting investors.
I think what we've seen more recently is a lot slimmer launches. I think people are looking to see what they can outsource. Can you find a risk manager in the market who's going to be hierarchically and functionally separate from the business when you've got a small firm? Is there a way that investors can take some comfort that there's an independent risk manager outside the firm that has no vested interest in the performance of the fund, especially in those early years where a risk policy perhaps is more likely to be stretched? Are there, and again, some of this is dependent on how you value your time and what you could do. I mean, a lot of people can put in a compliance infrastructure, but it takes a long time to write a manual. Are there people that can help you to put that compliance infrastructure in place? We talked about the fact that the FCA are more enforcement-led, and it's not always clear from kind of what they say as to what they really think is necessary for a size, scale, and nature of a firm, and having someone who can come in and do some of the heavy lifting about demonstrating that you're having those governance meetings that you need to have to document. And we talk a lot about the FCA saying that if they don't see something, it doesn't exist. And in those early years where you're trying really to make the most of performance, that you're really focusing on those bits that you want to do and want to do best. Is there someone else that can help do some of those reporting elements and make sure that your infrastructure is right for your business, doesn't stop you from doing business, but provides the regulator with the comfort that you've got the risks and controls in place.
And I think investors are certainly looking more at that part of their due diligence as well. And I think risk management's always been important, but post AFMD, it's something that is so much more important, and investors are sort of asking more questions on that as well, I think.
Yeah, I think so. I think this is critical, especially for institutional investors, because they are much more demanding. I would say in general, the primary interest for all investors is, buying a strategy that can make money. So it has to be a profitable strategy and has to fit the current market environment. So this is critical, of course. And so for some strategies, it could be much easier, to sell the investment idea, because also the current market conditions can facilitate that strategy compared to another one. And on top, for example, another aspect that could be interesting for all investors is, for example, the fund's liquidity terms. For example, a strategy that invests in exchange-traded products or very liquid products, if a company also buys very good funds terms, so you can exit the investment very easily, will receive probably much warmer reception from investors. But the problem is that when it comes with, the institutional investors, so the demand and the request for more information and more infrastructure becomes critical. So, and again, compliance infrastructure, legal taxes have to be sorted out, and needs to give investors a big reassurance about how this structure is being defined. But I would say a critical aspect of the due diligence process is understanding if the risk management process is sound and thorough, and in my experience, for Mirabella, for example, we got lots of interest from institutional investors who were requesting information about how the risk management function was shaped, so the competence and profile of the risk managers, how much authority the risk managers had in biting the investment management, decisions, and also the, authority and independence of the risk management function compared to, the other business lines, which is also a critical principle of the FMD. And beyond that, we got lots of interest in seeing the real policies, so investigating on how the internal framework has been shaped, because in many cases, the PPM is not enough, it's very vague, and investors perceive the PPM like a document that is giving disclosures to investors on what the risks of the fund are, but it is also aimed to cover the fund and the fund's manager, not the investors. So the investors are really keen to see how you have shaped your internal risk management framework, your investment guidelines, your portfolio risk profile, the operational risk profile, and the valuation risk profile. And I would say that in most of cases, the feedback from institutional investors is very, very good. For example, in Malta, where we also run the hosting business, we got these policies reviewed by the MFSA, and we got also good feedback as well in terms of having substance in how the risk management framework is being defined and approached. And I would say that in a few cases, having this collateral in place was a precondition for the institutional investor to put money into that business. So I think that's very important.
Yeah, and I think we're seeing a lot more substance to investor due diligence, and the amount of work they do to get underneath the surface, especially for pension funds and sovereign wealth funds, are keen not just to see that a policy exists and a compliance manual is there, but also to see that this is working effectively, that records are being kept. They can see that the compliance infrastructure is being kept up, and it's exactly what you say within your DDQs as well, because it's all very well to have something in there, but they are very, very keen to see these now in action.
Yeah. For those of us of a certain age, and indeed being brought up in the UK, there was a sketch show on Saturday nights called The Two Ronnies, and one of their most famous sketches is where they answer the question just before it's asked. So we have a question here: is where are you seeing demand from funds for outsourced risk management? Any further comments to add there, or have we covered that particular point?
No, I think we are. I mean, we are seeing certainly some interest, especially if you've got an investor check in front of your face, and you're aware that the FCA it's going to take anywhere from 4, 5, 6, 7, 8, 9 months to get authorised, and you're worried that check might go somewhere else, then I think hosted platforms are there to help. I think it is important that when looking at these, you do look at these in a material way, because they are mentioned. Certainly, if you're using them for your investment management, they are going to be mentioned within your PPM. Investors are going to ask questions. I think it's essential that you consider the reputation of any host provider that you're going to use. Clients of these are, and indeed ours, are on the FCA website, so it's not difficult to ask that you get a reference from one of those that perhaps is not picked by the provider there. And it's also important that no one's doing, that if you're looking at providers, that they've not got other in-house activities that might conflict with what you want to do, that they're going to continue to look at you in the way they do. Where we see it, and I think we would say the positives of hosting, we do it day in, day out, but it does cover a lot of the things that we've been discussing today. It is an independent risk management function. You've got a ready-made compliance department full of compliance professionals who will make sure that the risks of your business are managed. And I think Elisa can talk more about kind of how risk management's done.
Absolutely, and in terms of this solution of outsourcing or having an in-house solution, I think of course if you have lots of internal expertise and you have time to devote to writing the policies, it's always a good solution to have also an in-house risk management function. But in most of cases, because of the restrictions imposed by regulation and also from a commercial point of view, it might be even less costly to outsource risk management to another company who know what they're doing, ensuring independence, competence, authority, all in one shot. So I think that's very important. And I think the other problem is time, because of course drafting these policies and procedures and having a very good ongoing monitoring program at the risk management level requires expertise, time, and lots of effort, especially now when, after 2008, there is lots of emphasis on a control risk management framework, also because investors have been disappointed about hedge funds. They felt betrayed. They were caught into gating, redemption, suspension. So they expect a lot from hedge funds before they can invest and commit money to it. And so we need to show a very, very good infrastructure, and risk management is a critical part of it. So that's why sometimes outsourcing or delegated risk management could be a solution, just because also this sends a very clear message to investors because of the reputation of the hosting platform or the delegate risk manager. So that's my perspective.
I think there's another couple of sources of growth in demand for hosting solutions around people wanting to prove a concept, first of all. There are certain advantages in terms of saving your scarce capital, because you don't need to hire an independent risk manager full-time, for example, but you also don't need to put up any regulatory capital as a hosted firm, and allows people, before they make that big leap to put aside the capital invested in a business, go through the rigmarole of FCA application to really prove the concept, start talking to investors and see if there is any appetite for the strategy out there. So that's another
And it also
route.
gives the opportunity to, we've talked about the difficulty perhaps in getting risk managers and getting the right staff in place. And I think it gives an opportunity. It is, the way that these platforms work is that you are seconded into a firm to enable you to do those activities you want. So you do need or you can get away with a much scarcer body of people. So if you are, as Matthew says, trying to prove your concept, trying to demonstrate to investors that this is working, to demonstrate that your strategy works and you've got a good risk policy, I think it is a way that can help that.
Yeah, I think it's certainly something that clients do use, particularly, once you've got an idea and you want to get started, there is that timing issue in terms of sort of getting the FCA authorization, but you've got to make sure that you're walking on the right side of the line in that interim period so that you have got coverage. And so sort of having the hosting solution actually helps in that respect, either more long-term actually from the risk management perspective or on an interim basis. And I think, John, as you mentioned, in terms of making sure that people look at reputation of the firms that they're using, that's really important. And also making sure that they are familiar with your investment strategy, and so that they are actually able to sort of add value and assist in that respect is really important as well.
And if I can just add one extra point, I think the other challenge is to find a risk manager with the right CV, because 10 years ago the risk manager was a mathematician or someone who was doing lots of number crunching and supporting the investment manager. But now the risk manager needs to be expert of regulation as well, because we are working in a very tight regulatory environment. So, and I can tell this because all of my team now is much closer to compliance issues, and we need to be on top of any other regulatory constraints coming from current regulation to be able to do our work efficiently. So just wanted to add this extra point.
Eve, is there anything different that people need to consider if they, from legal documentation? Obviously, there's different parties involved with a platform, but anything else people need to consider?
I think one of the things that's just worthwhile considering is obviously, and this has been in the UK for a while, but there are two sort of options really on this side. One sort of going down an appointed representative route, or one sort of having more of a managed solution. And again, it's making sure that the provider that you're using has the correct permission scope, because in terms of actually the appointed rep route, you can only advise and arrange there. So from a legal perspective, if you want to manage, that route wouldn't necessarily work. So you'd need to make sure that you used a more managed solution. So I think that's one thing just to bear in mind from sort of a legal perspective. But equally, from the documentation, as you say, Lawrence, it's making sure that you've got the right documents in place. And again, that the offering documentation will clearly sort of state all the different parties involved. But,
what sort of businesses do hosting platforms aren't suitable? What are they not suitable for? What sort of clients do you wouldn't come to you?
It's a difficult one. I mean, I suppose our core clients are advisor ranges, as we've talked. So those advising an offshore manager, those that private equity, real estate, hedge funds, we can deal with. Even introducing brokers come to us. I suppose when you get further into a broking model, that's where we have the issue. I mean, again, I think as well as UK regulations, you also have to consider US too, and make sure that if you are seeking to get that access to the US market, that you've got that provider also has the right CFTC and if you're using futures and SEC clients to enable you to raise that money in that way should you wish.
I mean, that leads on to brilliant. Another question that we're just leading on to asking is, what is the FCA's view of hosting platforms, and indeed other regulators?
Yeah, I mean, this is difficult. There is no rule book for hosting platforms. We've spent a lot of time looking at the framework within FSMA and within the FCA rules to understand kind of what the expectations are for hosting platforms, and indeed trying to engage the FCA as to their expectation. I know there was a high-profile case last year, Porto Verde, who were shut down, who were a host more in the retail world than our wholesale world, and really retail is where this started. If people are aware of the kind of I suppose the networks that appeared. So we've worked a lot when we've tried to demonstrate to the FCA what we do and kind of the infrastructure that we've put in place to make sure that this fits as nicely as possible in almost artificially against how the regulations work. We do think with the FCA struggles through, I think well-publicised struggles through the AFMD authorisation process when I think they even put out something that they were missing their own targets during that time. It has been a struggle, and there are us and a number of other providers that have stepped in really to make sure that people can continue to raise money and get going. But I think this industry is bigger now and will be put under kind of review by the FCA. I think investor due diligence goes a long way, and we take that very, very seriously and take a lot of lessons from. Particularly the pension funds and the sovereign wealth funds always have some ideas about what their expectations are and what they expect to see in control frameworks and risk frameworks, and that's what we've sought to ensure that's working. So there is no, I don't think we don't think that's the right answer. We certainly think there's best practice and a way of doing that will make investors comfortable. As I said before, they are in the PPM, although. This can be changed once a firm gets authorised without having to go back to the shareholders. But they're a key part to that initial process, and I think the selection and the way that the provider works is essential to understand.
Picking up again on that question about investor ready and investor due diligence, got a question from the audience. A number of startups will be below the remuneration code. But even for those who are that sub-threshold, how important is it to have a remuneration policy in your your investor documentation?
Well, I think investors expect to see something, as the FCA will do if they come in and have a look at you now. You know, we all know there's some pretty helpful proportionalities scheduled both in the £1 billion hedge fund, 5 billion real estate caps in the AFMD code and the MiFID code, where you can, or sorry, the CRD codes, which you can pretty much turn off all the more biting constraints. But I think with investors, they want to see that someone's got something to lose if things don't go as well, and that they think about the way in which remuneration is considered, that it's risk-based. There's some framework around how that's paid. I think the Weavering case and the amount of money that he paid himself for the fund going wrong is another example of making sure that investors are comfortable with how your remuneration is set up.
Yeah, and even sort of outside, I suppose, regulatory requirements on Rem code and things like that. But investors just do want to make sure that managers have got skin in the game and that they are actually invested, so that they are putting their own cash in, and that's something that has been the case for a number of years, but I think has become even more critical and important to investors in the last couple of years as well.
And I think this is important also for risk managers, because best practice also, I think, have a say on how risk managers should be remunerated for all managers, because in general, a fixed salary is welcome compared to like a variable remuneration, for example, linked to a performance of a particular strategy, because in that case there is a natural conflict of interest for risk managers. So I think even if sub-threshold managers might not be caught by the remuneration policy for some reason, then from a pure best practice perspective, it's very important that there is something in place also for risk managers.
Sorry, you look like you say something there, Matthew.
Yeah, just that there's a natural tension there between Rem code considerations pushing you more towards fixed pay and regulatory capital considerations pushing you more towards variable pay, because the higher the variable pay component, the lower the regulatory capital need. So just getting that balance right is something to consider. And investor perception is a key driver.
Yeah, absolutely. And I think what matters for risk managers is that, that variable remuneration is not linked to the performance of a particular strategy. So that's, I think, the point investors will look at, in reviewing the remuneration policy for risk management function.
We've been focusing on that relationship between sort of the manager and their investors. And remuneration is a key element in terms of how the business is run itself. How important is it to get that internal structure, whether it's an LLP agreement or it's a shareholder agreement or proper employment contracts in place to run this business like any other business?
Yeah, I mean,
John, Eve?
well, from it's tax, there's critical, but I mean, from a legal perspective, again, getting that sorted at the outset is really important, and sort of working with the tax to make sure that whatever entity that you use, and there's been changes recently, John sort of can deal with, but just make, that's really important that that's done, and making sure that you have got your shareholders agreement, and that's sort of what LLP agreement and employment contracts all done at the outset, again, to sort of get that infrastructure set at an early stage. The tax, I think, is probably more critical on that.
Yeah, I mean, there have been some changes recently, but kind of, I think rumours of the death of the LLP are very much exaggerated. It's still perfectly feasible to use an LLP structure rather than a company. It's got a lot of flexibility. It fits quite nicely to somebody starting up a business who's maybe got lots of recent taxable income. There's the flexibility on initial trading losses. There's also more flexibility in terms of reallocating value within the business. So if you've got somebody coming in and you want to give them equity, it's easier with an LLP as opposed to a company. And even when you exit, a sale of a partnership interest is eligible for entrepreneurs' relief, whereas for company there's a minimum holding of 5%. I mean, obviously you need to decide what you're going to have before you proceed to then start sort of going for all your permissions, and so clearly you do your tax planning at the outset and decide on the structure of the vehicle. I mean, it's not just business tax, of course. Then if you're going to employ somebody, you need to set up payroll. So you can't pay somebody without paying tax over PAYE and NIC over to HMRC. You want to get VAT registered pretty quickly because, I mean, everyone knows that financial services are VAT exempt, but of course the exemption around investment management is pretty narrowly drawn. So unless you're actually active in the UK retail space, you should be able to recover probably all of your VAT actually. So you want to get registered for VAT quite early on. And yeah, I mean, I think it's just deciding the structure and then go through the kind of tax housekeeping really.
I think one of the things as well which has become more, I think it's always been the case, but that document can get quite heavily negotiated, particularly if you've got a cornerstone investor that's coming into your fund. Actually, a number of those cornerstone investors will want to take an interest in the manager as well. So that documentation can be quite heavily negotiated, and the terms of that and the interaction between their role sort of on the advisor or the manager and the sort of their role as an investor in the fund needs to be considered. And if an investor is coming into the management side of the structure, they will take a lot more of a keen interest as to making sure the structure is right and that you've ticked all the boxes on the legal and the regulatory and the tax side as well, because they'll obviously have sort of a vested interest in that part of the structure as well.
Just chip back in because I sort of bigged up the LLP, but Matthew said earlier on about you may get to a stage where you have to reinvest capital, and maybe you'd want to flip into a corporate structure when you get to that kind of mature stage in the business, and you can do that. You can restructure from one to the other.
Just two observations on sort of constitutional documents. The first one is that it is fundamentally important if there's two people setting up in business as so-called equal partners, there must be a tiebreaker arrangement in there. I've seen a number of occasions now where two people set up businesses with the best intentions in the world of making this a long-term play where they were both aligned, and getting out of those arrangements if things go wrong is almost impossible should you not have some kind of tiebreaker or arbitration type clauses in there. So that's quite important. Second point was really that, particularly with an LLP agreement, but also the case with articles, you can really use this to set out on day one how you are going to run and document your governance. And we've talked about tax compliance, VAT compliance, adhering to risk management policies, regulatory compliance. A lot of those things follow if you have good governance and you can demonstrate to investors and to the FCA alike and auditors when they come around to visit once a year that you actually have good, solid, robust governance procedures, and all of those parties will expect to see some actual evidence that these things exist in practice. So actually documenting the governance procedures that take place is very important as well.
And I think actually just to add, Matthew, one thing you just said on particularly with LLPs, actually if you don't get something down in writing, the default position under sort of the LLP legislation, which is pretty basic and you could probably write it on the back of a very sort of A4 piece of paper, isn't necessarily that favourable. So for example, members share equally in the profit. So if that's actually not the intention and you want to actually have a different arrangement, which is usual, it's really important that actually you do have an LLP agreement in place because the default position is, as I say, pretty basic.
Just on that very point, if you don't have an LLP agreement in place, your capital will not be regulatory capital for those purposes, for prudential purposes.
Sort of all the things that have been picked up, I'm picking up from your comments is there's an awful lot to think about. And I know us at Cordium can assist, Eve can assist, but what are the other sort of providers, the other people that sort of help managers when they're busy? Who have we seen? What do firms do to deal with the fact that there isn't enough hours in the day?
Well, I suppose the other players, fund administration is pretty critical, sort of in the fund space. And I think historically a lot of managers would get their fund administrators on board quite late in the day. And I think it's really important to make sure that you do identify fund administrators pretty early on because they play an integral role and they can make life so much easier in terms of if you're small, even if you're onshore rather than offshore, but in both instances, if you're a small startup, that administration aspect, it's really helpful to have the fund administrator on board and make sure that they've reviewed the fund documentation as well so that actually their systems and processes work with what's been decided. auditors, bankers, others as well, placement agents, if you are looking to sort of for assistance on the fundraising process as well, are all sort of other sort of key players that we tend to sort of see clients use at those early stages.
Yeah, I suppose allied to that is the right prime broker for your
Yeah.
strategy as well. A depository that fits the requirements of the AIFMD, whether that's a depository like for the offshore models or the full depository models for the onshore hedge fund. I suppose also that can be put through in the due diligence questionnaire again. The investors want to see the right names on these. They're key to I suppose that fundraising effort. And then if we look at it from an FCA due diligence perspective, the FCA are getting a lot stronger on making sure that you really understand what the providers are providing you, that you've done appropriate due diligence. We saw this a huge amount through the AIFMD VOT process, where they were asking a lot of questions about how you got comfortable with the providers, how you oversee that they've got SLAs that you can really get hold of, and break clauses should there be a problem. And I think one of the areas that we see particularly, or particularly you need to get worked out, is that the administrators as well, is to make sure that they're not too big, that they're not going to focus on your fund and picking the right one that will be accessible, will know your, as Eve says, your strategy and understands what you really need at that startup phase.
Yeah, and from a risk management perspective, I think choosing the right prime broker and the right trading counterparties are critical, especially in the OTC space. Of course, there is all the ISDA negotiation and the broker contracts negotiation, which is more managed by the legal department. But from a risk management perspective, having access to the information from the prime broker to upload positions and process all the risk management models is critical and can be heavily affected if the quality of the prime broker of the trading counterparty is poor. So that choice is critical for the risk management function and the right functioning of the operations. So it's very, very important.
We haven't actually got to running our business yet. We're all the issues about sort of getting investors and getting us regulated, or being on a platform, or getting our service providers together. So, day one, we have our strategy to go. What are the business issues that will be these firms face over the first 18 months? Do you want to start on that one, Matthew?
Well, we've obviously thrown a lot of things out there already, and some of that is upfront activity, but some of it is actually living it once you get going. So there is a question as to how much time do you need to devote to raising assets, communicating with investors once you've got them, and running the money to generate the performance, because frankly, that's what people are paying you for. So it's working out what is the value of your time and the team's time, and then working out what it is most effective that can be given to counterparties you have due diligenced appropriately and can hold to account to SLAs. So managing the time in order that you can deliver the performance that you set out to achieve, I think is probably the primary concern at that stage.
And I think probably another critical factor is having the risk reporting structure right. So basically in the onboarding stage, when you have to define, the whole investment management structure, it's very important to define, how your reporting mechanism will work. Reporting mechanism to the senior management, to the funds directors, to the board of the investment manager, so that communication is circulated properly across, teams and, to the governance structure. And so this is very important. It's something that needs to be sorted out, during the setup stage, I think.
And I suppose sort of just leading on from that as well, unlike an M&A deal, like your fund documentation, they're living documentations. They won't just sort of sit in the bottom of a drawer and just not be seen for sort of years. It's really important to make sure actually that you do keep an eye on the fund documents, what you've agreed to, particularly if you've agreed different side letter provisions with a number of investors. So sort of when you've got your closing, making sure that you've got a list of all the different sort of side letter provisions and what you've agreed to, and making sure that that's easy to follow. So that you don't trip over that and have sort of any breaches inadvertently in the fund documentation going forward, sort of aside from sort of all the risk and the reporting, but actually just on doing the deals and what you've agreed with your investors. That is really important because they are very much sort of live documents.
I think it's important as well that, as you go through those early times, you've got a lot of, trying to keep on the right side of the regulators is important. You get past that, we've talked a lot about the compliance infrastructure, but there's a lot of reporting that gets done to the regulator, whether that's the balance sheet, income statement and capital reporting that you've done, or as many of us have struggled over the last few weeks in respect to the Annex 4 reporting and trying to make our way through ESMA, hundreds of pages of ESMA guidance or lack of it for a number of questions. So I think it's important to understand what the regulators are going to want and understand in what format they're going to need it to be done, and make sure that you are set up to make those reports, so you don't send red flags to the regulator in the early years to say, look, we don't understand what we're doing and we need a visit.
Well, one of the questions that we've had is, and this comes back to your application document with all your projections in and your cash flows, does it make a difference how regulatory capital is held? In terms of you put it in your balance sheet, but going forward, that's only a projection. How do you manage that? How do you watch that?
It is indeed only a projection. It does make a difference how it's held. I've already mentioned that if you're an LLP and you don't have the right provisions in your LLP agreement, it's capital for legal purposes, it's capital for accounting purposes, but it's not capital for regulatory purposes. So we have seen that to be a hiccup for some people. We find that the FCA do not focus on it very closely, and then a firm may come to us purely to do its regulatory reporting. We ask for some documentation, we ask for the balance sheet, we ask for the LLP agreement, and we say, oops, that capital isn't regulatory capital. Now that's a big problem. You really don't want to be flagging to the FCA in your very first returns or before that you actually haven't got any regulatory capital and you've been in breach from day one. So that's of fundamental importance. In terms of ongoing, it is something you need to keep a watchful eye on every month, even intra-month. So what we tend to do for clients is we present them every month with their regulatory capital statement, whether it is a reporting period or not. We revisit some of the variable numbers within the requirement, so the fixed overhead requirement or the expenditure-based requirement and various others, to see if those figures as projected are actually still valid given what's happened in the business since it's been authorised in the last few months and what the business expects to happen going forward. So that forward-looking piece is very, very important, because the last thing you want is to be told you need to put your hand in your pocket now and find another 50, 100, 150, 200,000 pounds. Because frequently that sort of capital is likely to be tied up somewhere. So looking forward, considering the risk, considering in advance the variability that's possible against the projections, allowing a buffer at stage one and an all stage looking forward and topping up as necessary. So there is a bit of a technique around producing projections for for the FCA application. They've got to be reasonable, they've got to be robust in accordance with UK GAAP or IFRS, so on and so forth. But also, you don't want to over-egg it and have to over-capitalise on day one. You want to present a picture which is fair, reasonable, and balanced, but not overly aggressive in terms of your asset raise, to actually keep some of your powder dry. So the calculation will say, in order to prove 120%, I need to put in X. Fine, you put in X, but you actually had Y, which is 50% bigger. Keep the Y somewhere else. Don't lock it up in the business, because once regulatory capital is in, it's locked in, and very, very difficult to get out of the business. Don't lock it in, keep your powder dry, keep a constant watch on how the financial landscape for your business is developing, and top up as necessary is the way I would advise to monitor that.
We've got a question that leads on from that, and is what do we see, or what do you see, probably because you'll see it more than the rest of us, how is the manager company, whether it's LLP or limited, generally financed? How much is actually coming from the manager or seed investors? Do we actually see external finance, bank finance coming in to run these businesses?
Well, the problem with debt finance, for example, is that you can't count it one for one against equity capital. So there are some strict limits on that. Your Tier 2 capital can only be a maximum of 50% of your Tier 1. Tier 1, you're unlikely to get anything that's debt-related in there. So there are some limits to the effectiveness of some sources of external finance. In terms of who it's coming from, well, it depends. You've mentioned seed deals there, and seed deals can be quite attractive. Clearly, locking in some capital into some assets into the fund, locking in some capital into the business can be a very attractive way of doing that. One thing I should mention is many of you will know this already, but we do frequently get people who haven't run a regulated business before. They've been very good traders, but not run their own businesses, coming to us thinking, okay, there's a £50,000, €50,000 requirement, minimum requirement. I understand that my actual requirement may be bigger because I need to fund my business. Do I need to keep £50,000 in cash, €50,000 in cash? And the answer is no. That money can be working capital within the business, subject to some haircuts, but there's not actually strictly a cash requirement. For the accountants amongst you, and there probably are one or two who are embarrassed to mention it, it's basically a variation on the bottom half of the balance sheet rather than on the top balance sheet.
We've also got, John mentioned VAT, and I know that you do a lot of VAT work, Matthew. Got a question on the impact of the fund domicile for VAT. What happens if it's UK domicile? Does that affect the recovery?
Will do, typically. The rules around this are it's still a special investment fund and therefore not within the scope of the exemption, and therefore you can recover your VAT, provided that you're not actively marketing that fund to retail investors. There is an absolute limit at 5% of retail investors in the fund, but even below that 5% threshold, you've got to consider whether you are actively marketing it to UK retail investors. So that's the trigger. And we have had HMRC focus on this on VAT visits to some of our clients recently. They seem to have smartened up to the fact that there may be some potential for HMRC and Treasury to keep a little bit more of the VAT pot. So we are getting some challenge around this.
Yeah, the exemptions widened a little bit over recent years with various cases. So you've got the investment trust companies and fund administration, that sort of fall, and offshore funds which are distributed to UK retail customers. So basically, UK and offshore equivalents are treated similarly.
The UK is still in a strong position as a centre for the offshore fund industry, given that we do have this ability for managers to claw back most, if not all, of their input tax. But yeah, we are seeing some cases in Europe which are seeming to chip away at the edges of the UK's ability to operate that regime.
If you had an offshore fund distributed to offshore retail investors, then a local fund manager would be suffering the VAT exemption if they were based
correct.
in
So
another
a UK
so
manager managing a non-UK fund which is marketed to retail investors outside of the UK, subject to all local private placement regimes or any other regulatory concerns, of course, I need to add, would not be subject to the limitation on recovery of its VAT, because that's only actively marketed to UK retail investors, I should clarify.
We are covering later on what happens when things go wrong and the regulator, but we do have a question now on regulation and regulatory capital. What happens if a firm has a regulatory capital shortage? How does the FCA react?
How the FCA reacts depends really on how it's communicated to them. So, you want to identify this promptly, you want to communicate it promptly, you want to identify in your communication what you are doing or hopefully have done to put it right. You also want to identify, importantly from the FCA's point of view, what you've done to ensure this situation doesn't arise again, because they want to understand that their decision to authorise you in the first place wasn't based on the false premise that you would be managing your prudential risk in this case. So yes, really setting them at ease is the name of the game, but prompt disclosure, full disclosure. Principle 11 says, tell the regulator everything you think the regulator needs to know. So you really have to set their minds at ease that you've got it under control and it won't arise again. So just explaining what processes, procedures you put in place to monitor capital if you didn't previously have those procedures or they were found wanting in some way. What procedures you've got in place to escalate capital issues through the firm so that providers of contingent sources of funding can actually be alerted in good time to make that contingent funding available should it be necessary.
Yeah, Matthew's right. And I think it does make a difference whether it's a Pillar 2 capital issue or a Pillar 1. I mean, Pillar 1 is a threshold conditions breach, so the FCA will take that a lot more seriously than the Pillar 2, where you might have some time to build that capital back up. But you do want to be very clear in your communication. You do want to be very clear on how you're going to make that up and very, very quickly. Thank you.
We've got one question we've had in is, and probably summarises everything we've talked about this morning, is what's our estimate in cost of setting up, starting a new hedge fund to what it was previously? Now, I appreciate these are now fingers in the air. Or alternatively, a different way of expressing it, how big a pool of money do you need? And how does that differ now from what it might have done a few years ago? And I never said these were easy questions.
And I have seen two-man hedge funds without a Mayfair office submit applications and have them approved without too many questions asked with a regulatory capital starting position of £80,000–85,000. Now, that number is going north as AFMD comes in. Really, part of the question is determined by what sort of strategy you're running and what sort of fees you're able to charge and your fee basis. So there have been known pressures of hedge funds over the last few years around fee bases. But if you are managing something which is more retail-y, then you'll have a different fee structure altogether. You may well be offering your seed investor, who might be your only day one investor, if he's writing you a nice sizable check, you may well be offering him a fee holiday or a permanent fee discount. So you've got to factor those things in because, of course, one of the numbers you need to take off in calculating your regulatory capital resources is any losses to date. And unfortunately, you can't bring profits into account for regulatory capital purposes until you've had an annual audit. So sometimes it's worth paying the auditors a little bit more to come in and do, and we're not auditors, I've got no vested interest there, pay the auditors a little bit more to come in early and do an interim profits review, which allows you to take profits into account at an earlier date than otherwise would be the case. But key drivers are the things that impact your revenues, things that impact your costs. So costs, do you need that Mayfair office? How many people are you going to have? Do you actually want to have day one a full complement of 5 people, which is perhaps something you could get to in 5 years' time by slicing and dicing the work differently and using outsourcers as a way of having it as variable cost rather than as fixed cost to the business. So how long's a piece of string is the answer to the question.
On the legal side, it's difficult depending on the different strategies, but what I try and do is make sure that you sort of stage the costs as far as possible so that actually you're not having everything in one go until you've tested the market and then you know what investors want, so that you can actually then, once you know that you've got investor appetite, you can then start incurring costs more substantively than in the initial stages, which I think is quite important for startups.
This leads right back into the FCA financial projections. If you can paint a story for the type of structure you're going to be running, where you can manage with 2.5 people, that's a significantly different picture from one you paint where you say, I need 5, I need 6. Now, just because you projected that you'll have 2.5, and the costs associated with that, and the requisite amount of capital to fund the business to that level, doesn't preclude you, of course, from, once you've got more revenues than you projected in those projections, actually enhancing the infrastructure, bringing more people in. So that's where you are able to then drip feed the capital in, which is where he was alluding to. It's minimize that day one capital spend and then drip it in as you need to. But of course, that requires you constantly monitoring your capital position and topping up as and when.
It is one of these things is we see a number of clients who, with the best one in the world, would say, perhaps you could do with a little bit more sort of investor money to make this sing. Most people know that. And there's a comment here from someone in the audience that Citi says you need $330 million AUM to break even. Now, whether that's the fees that Citi charge, I don't know. But anyway, it is Citi. That's a comment from someone in the audience. In terms of other questions, I mean, coming right back to the start, question from the audience is, why would somebody choose the UK rather than Ireland and Luxembourg as a fund location? I mean, you mentioned earlier, but it's a transparent job.
Well, I mean, there's various sort of tweaks. And in the old days, when UK funds were taxable, they didn't really pay any tax anyway, because there's no corporation tax on dividend income. Bond funds got a tax deduction for the distribution. But basically, the headline was UK funds were taxable, so nobody liked it. So then they came up with a tax-exempt regime. They also came up with some tax-transparent funds, so you can have a contractual or a partnership structure where the investor is taxed directly on the underlying investments. So the UK has kind of made strides to make itself competitive with somewhere like Ireland or Luxembourg. But I think the question is, would you bother to relocate once you're set up in Dublin or Luxembourg? I don't know. I mean, I think once you've started up and got it up and running, you're probably not sufficiently incentivized to move back. But it is, Luxembourg and Ireland aren't places where fund managers tend to live. It's kind of my, don't know if that's not necessarily.
It comes back to one of the points at the beginning when you're actually talking to someone, where are you based and where are you wanting to do what you do? But I think a lot of that also does turn on asset classes as well, because I think historically actually having an English limited partnership for a private equity fund or a real estate fund has actually been quite sort of a tried and tested model. And actually pre-AIFMD, those sorts of managers actually had quite a light regulatory regime. And so if you are actually sort of sub-threshold and you are in the sort of the private equity real estate space and you are here, you're in London, you're in the UK managing, actually there is a rationale for having an English, an English or a Scottish limited partnership.
I mean, it's worth saying if you've ever tried running an offshore holding company, it's a bit of a nuisance to kind of go out to Luxembourg or to Dublin every time you have to have a board meeting. So there is a convenience thing, and if you think about a corporate fund with a sort of the manager, the operating company, that you can't make that resident anywhere else. If you have all your meetings in the UK, you risk making the offshore fund UK tax resident. So it's not, whatever UCITS 4 says that you can have your operator wherever you like, you still need to have it somewhere that's not going to try and grab up the fund and turn it into a taxable entity. So if you're the fund manager in the UK and you're trying to run an offshore fund, I mean, I've had previous experience in, not with a fund, but with a corporate holding vehicles when we used to have dividend mixing. And every time something needed to be done, you had to say, well, sorry, I can't sign that in the UK because it's a kind of tax residence thing. It's run over in Luxembourg or Ireland, and it's just inconvenient. You have to get on a plane. And so that is it.
I've talked a lot about words today, which is perhaps strange for an accountant, but again, documentation comes back into that, because to prove the robustness of your tax structure that it is operating as it does on the nice organogram that you started off with, a lot of that involves actually moving the right pieces of paper to the right people at the right time, making sure they've got enough time to review, carefully consider, challenge, and then documenting that those processes have happened, including the challenge. I used to be a fund auditor for many years, and so I've spent a lot of time looking at precisely that risk, the risk that a UK-managed fund fell foul of the IME or for other reasons became a taxable entity in its own right in the UK. And I always struggled when I saw board meetings which said the investment manager turned up or phoned in, talked about performance for a few minutes, it was all okay, and then we signed the annual accounts. Those things I struggle with personally, and there is limited risk that HMRC can lay their hands on the fund's documentation because it sits outside the UK, it's held by somebody else. But in this world, we're moving to of increasing tax transparency between jurisdictions, increased cooperation between and interplay between tax regulators and compliance regulators, conduct regulators. I think access to that kind of documentation is going to become a lot more available, and therefore the firms that don't have robust documentation that demonstrate that the challenge has taken place and being responded to appropriately are likely to suffer.
We do think that there is some benefits from the AIFMD, and that has given some structure for an offshore manager. I mean, and I'm sure people have seen that we've got Malta on the bottom of our side. I've seen Malta as an interesting place to do business with some low cost ability to start up and have an AIFM doing risk management, especially with the framework of delegated risk management. Now you can have your AIFM that takes responsibility for risk management in a lower cost, and certainly if the owners of the business are tax non-doms, UK non-doms, there's some interesting tax issues that we're going to come on to, I think, later on in the session. But I think AIFMD does give a framework around how you might set a structure up with an AIFM in one jurisdiction, however, with an investment manager in yet another jurisdiction doing that investment management with a much clearer idea of how that governance works, a documented big piece of legislation that backs that up.
I think actually one thing that AIFMD has probably done is actually aligned the tax and the regulatory on the substance issue and making sure that there is substance in the jurisdiction where your fund or your manager is, if that's not where your advisor is. And I think there's definitely more of an alignment now than perhaps there was before. Previous, I think it was more of a tax driver. Now it's both tax and regulatory driven.
Thank you. That was all of that was really interesting. And we're now up to lunch, so I'm going to call a halt there. We've got a number of questions that we haven't got around to answering. We'll try and get answers back to people who have asked those questions. I have been asked to make some announcements about the iPads, and I shall now read rather than try and do this sort of ad lib. On leaving the atrium for lunch, you can keep the iPad with your belongings as long as you don't leave the building. Yes. You can also hand your iPad back to our staff that are at the back of the room. There, and there. Yes. Please make sure if you do this, you go to the home screen and log out. When you come back in, you can pick up any device, log in, and it will remember your history. I've got a thumbs up. That was exactly excellent. Right. Please enjoy lunch and look forward to seeing you this afternoon. Thank you.